The market's already up 24% year to date from the S&P 500 perspective. This would be the third time in 4 years that we've seen a gain over 12 months like that, and that is very unique unto itself. Election or not, we've actually seen a pretty strong adherence to seasonal trends as we've made our way through this year, as well as we did last year. December is shaping up to be more of the same. In election year since 1950, the S&P is up in December 83.3% of the time. Similarly, December rarely produces a noteworthy bearish performance, with only one time since 1950, election year or otherwise, producing December as the worst month of that given calendar year. But this year, likewise, produced a gain of more than 10% in the first half, and in years with which the S&P 500 rallies more than 10% in the first half of the year, December has rallied 100% of the time to an average return of 3.4%. In recent years, however, this data series is a little bit more wrinkly, if there's a lack of a better phrase. Stocks have been up 6 of the past 10 Decembers, but each of the S&P and the Nasdaq 100 have averaged negative returns over the past decade. And this is the time of year when volatility starts to turn higher, which I think contextually, we're looking at a VIX below 15 right now. December, January, February has been the most consistent time of the year for a sustained rise in volatility over the past decade. So I know you guys aren't big adherents to seasonality, but last year and this year, seasonality has actually been a pretty good guide. Choppiness in the first few weeks of the year, a rally into the summer, you fall off into the fall for a fourth quarter rally to be staged that brings you into new all-time highs. Should we as traders be putting a little bit more stock into this in 2025 if we've been ignoring it in recent years? That's my question to you.
This 100%, should we ignore it?
When you say we should be putting more stock into it, what do you mean by that? Like, I'm asking, what are you thinking? Are you thinking as a continuation or to fade it?
Continuation with the seasonality trends, which would be, quite frankly, given the first quarter, would be bad for stocks. Stocks would be looking at a choppy January, a rally in the middle of February, and then a pullback into March. And then once you get into April, through the middle of April, you look at a more sustainable rally through the middle of the year. Is the table set for something like that as we head into 2025? Should we ignore that tendency of the market as it's behaved for the past few years outside of really 2022?
You're asking the wrong person. So I recently gave a software demo when I was doing a bunch of trading shows in London. I mean, in the UK. And I used the backtesting platform at each event just to give a quick little show of what we have on the software. And every single example I gave in the backtesting platform, Chris, was of strategies that had failed miserably over the course of the last 12 months. For example, the one I used almost every day was selling puts in Boeing because I was going to sell puts in Boeing because the stock got down to 138, 139 when we were doing the shows. And I was showing that if you'd sold puts in Boeing all year, you would have gotten killed. So that's why I was showing it, for the simple reason that as a contrarian, now it's time to sell puts in Boeing. So when I listen to what you're saying, the only thought that goes through my head is, given the size of the rally that we've had this year, and given the fact that we really haven't had any kind of sell-off or anything like that, sure, we should be using this information, but using it with a contrarian approach, I believe. And, you know, it's the dogs of the Dow type thing. It's time to do the opposite. I mean, that's just the way I think. Like, I'm not saying it's right or whatever. It's just the way I think.
So you'd rather be wrong?
I'm not saying you don't know if you're going to be wrong or right. I would rather do the opposite of what everybody else is doing than think that that history would suggest that anything else is relevant. Like, the only thing to me that's relevant is to do the opposite of what history suggests.
Well, Tom, let me give you a piece of information here that might titillate you.
Okay.
Typically, in the average year, analysts, when they put together their 12-month ahead forecast for the S&P 500, over the past 25 years, they've been guiding higher by about 8.8%, which isn't really heroes work, because if you look at the return of the S&P 500 since World War II, it's about 8.7% annualized. This year, the average return, the average price target for the S&P 500 through the end of 2025 is about 11.1% higher than where it stands right now. This is the highest degree of price improvement that analysts are forecasting going into the next calendar year ever. Everyone's this bullish. No one's ever been more bullish as we make our turn into the next 12 months. So you want to talk about a crowded market and a crowded perspective. Everyone and their mother is chasing this market to the upside right now.
Yeah. We saw a lot of the, 7,000, 6,800, 6,900, 7,100. Yeah, of course, they're all,
why not?
10 to 15% higher. Yeah, why not? I mean,
And nothing but
that's
upside action.
But that's what they get paid to do. They're not paid to trade. There's a big difference. If you get paid to predict, you can't afford to be different. You can only be better than your peers. There's no advantage to trying to play it any other way other than to be more right. If you're a trader, none of that comes in. None of that's part of the equation. That's where you draw the line between analysts and traders, and that's why they don't let analysts trade and traders don't analyze. It's that simple. So if you're a trader, all you can think about is, well, if every analyst on this side of the market, then statistically, I got to love my chances to the downside. I mean, you can't think of it any other way. There is no other way to approach it as a trader. That's it. That's why historically the funds that finish every year, the funds that finish in the top 25% virtually never repeat. That's why in sports, the teams that win, almost never repeat. I mean, it's the same. The top teams that make the playoffs almost never repeat. It's just the nature of, cyclicality and the way things and the way markets move. So I don't know. Again, it's a beautiful thing for traders. I think it's a dangerous thing for analysts, but they have no choice. If you're an analyst right now and you either miss this year by a lot or whatever, you have to say some number between 6,800 and 7,200. You have no choice.
Yes, save face.
Yeah, it's like if you're managing an index fund, you can't not be 95%. Maybe you can be 99%, but you can't be less than 95% invested. That difference of 1 or 2 or 3% or 4% is your job.
Yeah, we like to say that, if you're bearish in a bull market, you lose your job. If you're bullish in a bear market, not a problem. Your job's to invest money. It's a bear market. People are losing money. But if you're not making money in a bull market,
of course,
it's hugely problematic. This year, there are only 2 of the top hedge funds that are tracked by Bloomberg right now. Only 2 of them are beating the market, beating the S&P 500 this year. Discovery Capital Management, which is up by 46.5%, and Rokos, which is up by 28.5%. Everything else is missing the mark. If it's Citadel or Walleye or Millennium or Balyasny, they're all underperforming the market. So perhaps that has something to do, or we'll see a change in positioning relative to some catch-up that's due to do some window dressing here.
In the world of, the firms that you just mentioned, Walleye and Citadel and those kind of firms, I mean, they're prop houses. Their business is very different. They're not pure directional risk takers. Everything is spread off. And, those firms have an amazing history of, delivering spectacular returns based on their style, but they're not going to be much more than, 3, 4, or 5 times risk-free rates, Yeah,
Ken Griffin's not feeling too bad that Citadel's only up 20% year to date.
No, either is Irv Kessler at Walleye. I'm sure they're okay. I mean, those are the greatest. I mean, I don't know. Tony and I both think he's the best trader in the world, for the last 4 decades. So
you can't argue with consistency.
Yeah, I would never fade him. That's probably the best fund I've never invested in them or anything, but they're probably the best traders I've ever met. So I don't know.